Alrighty, folks, this is George Simons, founder of Solo. We are on live on the Debt Hotline today. We're going to be talking about tips from a debt insider, how debt collection really works. We're here with my friend Adam Parks. He is a veteran of the debt collection industry with nearly 20 years of experience leading innovation in debt portfolio purchasing, compliance, and technology. As CEO of Branding Arc and founder of Receivables Info, Adam has helped more than 200 debt buyers, collection agencies, and law firms modernize their marketing, improve transparency, and build trust with consumers. A former president of the Receivables Management Association, RMAI, and host of the Receivables Podcast, Adam is known for bridging the gap between consumers, collectors, and regulators, making the debt industry more ethical, efficient, and approachable. Adam, thanks for being on the show today.
I appreciate you having me. Hope I can be helpful.
For sure. So how did you first get involved in the receivables industry?
So I was a real estate investor and I was doing different types of business transactions in 2005 going into 2006, and kind of caught wind inadvertently that the current economy was not going to be able to stay at the same level forever, and kind of exited a lot of other businesses and realized that as the economy was going to go down, debt collection was going to be a place where I could have an impact. And so got into that in about 2006, and I've been involved in a variety of businesses. I've been a debt broker trading receivables portfolios. I've been a consultant with a variety of different firms and banks, and helped with the mortgage foreclosure crisis, helped to keep a lot of people in their homes, and worked through a lot of different types of roles. Compliance management, founded a compliance management platform to help organize and manage complaints, disputes, validations, and those types of things on behalf of the agencies, debt buyers, and law firms. And so my career has been, again, almost 20 years focused on debt collection specifically, but on that engagement with the consumer, compliance, security, making sure that we're keeping the information at hand secure, those types of things.
Cool. Adam, it sounds like you called the downturn in 2006.
Got
into the space right at the right time.
It was right at the right time. I mean, my story was really, I had a woman who was taking care of my home at the time, and she came in and told me about the $550,000 home she had just purchased. And I said, well, that math doesn't math. You're going to have to explain to me who told you that you could afford this mortgage. And then at the time, I had both a real estate and a mortgage broker's license in Florida. And she explained to me what they explained to her. And I said, but that's not how math works. And you're never going to be able to repay this. Like, this doesn't make sense. At the time, I was doing hotel syndication transactions and was doing other types of large real estate deals. And I said, there's no way that this is going to be able to support. I had honestly never heard of an adjustable rate mortgage before. And it currently scares me in our current economy, because adjustable rate mortgages are just hitting the same level that they were in 2007. So definitely something consumers should be keeping a close eye on. Just because it brings the payment down doesn't mean that the interest rate won't adjust in the future and your payment couldn't skyrocket overnight. Not to mention the balloon payments that sit on the end of those types of loans.
Right. Yeah, adjustable rate mortgages seem like bad news, for sure. I wouldn't take one.
I think there's some really rare occurrences in which they make a lot of sense for a consumer, but it is a pretty rare occurrence that it makes sense for your average person to do a negative amortizing loan, or really any of these, let's call them fancy mortgages, unless you're going to be paying biweekly and you're doing something to pay down your loan faster. It's the same thing that's got me freaked out when we look at auto loans and we start talking about 10-year car notes. Car doesn't have a 10-year life cycle. Like, we have to be really careful about how we borrow money if we don't want to find ourselves in debt.
Right. Yeah, like your Camry. I mean, maybe not your Camry, but maybe your Bronco. Your Bronco's going to be dead before 10 years goes by.
I think there's a fairly high probability that a vehicle is not going to be there at the end of a 10-year note.
Right.
And I think that's where the negative equity starts to come in. If you look at the average loan to value ratios over the last couple of years, new cars, it actually went over 100%. And now it's, around COVID, and it's stabilized around 100% of the value of the vehicle that's being borrowed on a new car. But the current loan to value ratio average for used vehicles is 127%. So people that got stimulus payments or whatever happened in their lives during COVID started paying more than retail value for vehicles. And then they end up rolling that net, whether there's an accident or whatever happens, they end up rolling that negative equity into other notes. And now they're borrowing 127% of the car's value, which means it's not appropriately collateralized, which means the interest rates are going to be higher. And I think it puts consumers at risk. Now, we all need a vehicle to get around, and I completely understand that. But I think we have to be careful in the vehicles that we choose and the amount of money that we're willing to spend on the vehicle that we chose.
Right. That's for sure. That's for sure. We don't need the nicest vehicles always. And then now people are going to have to be choosing. I mean, they're possibly in the future, people will be choosing between a 30-year mortgage or a 50-year mortgage.
Yeah, I mean, the 50-year mortgage, unless that's a transferable mortgage, and I've heard that argument made as well, I really would not. I don't think the consumer really benefits on a 50-year mortgage other than looking at it from the perspective of, do I get access to buying a home versus renting a home, which I completely understand.
Right.
But on the auto side, if we look at what President Trump has done in the last couple of days, changing the emission requirements, we're going to start seeing a lot more vehicles, a lot more less expensive vehicles available in the US marketplace over the next 12 months. And it became overtly apparent to me. I'm down here in Brazil right now. And as I look around at the vehicles on the street, there's no Yukons, there's no, Escalades. You don't see that. You see a lot of Fiat smaller vehicles that maybe don't meet the standards in the United States. And I think as that starts to change, some of those smaller vehicles will become available. But I was watching something the other day about like the Toyota Hilux, which is one of the most popular vehicles on the planet, not currently available in the United States, becoming available in the range of $13,000 to $15,000 brand new. I think opening up those types of opportunities and breaking the ability for car values to just continue to climb so rapidly is going to be really good for the consumer in the long run.
For sure. Yeah. Yeah. Unlocking vehicles at a lower price seems like a great move, right? And probably the same deal with houses. Right? I think sometimes the consumer can definitely conflate the concept of a low monthly payment equals a low cost overall, right? I think some people are susceptible to that error where they're thinking, "Oh, I'm getting a house. I'm paying only $1,000 on it because it's over 50 years. That means it's like a deal for a house." But oftentimes, people that have higher net worth, people that are like succeeding in the money game, they're thinking about the cost overall on an item rather than the monthly cost, right? Whether that's going to buy a car, they're doing the math like this car is going to cost me all in, interest included, $26,000, whereas somebody else is going to think, oh, this car is costing me $200 a month.
It's interesting that you say it that way, and I don't think it's just the consumer's fault. I think that's the way it's pitched to them at the car dealerships. I bought a vehicle last year, and when I went in and I was comparing, the options for leasing versus the options for purchasing, and when we were talking about the leases and I asked what the money factor was, the guy looked at me like I had 10 heads. So even the salesperson had no idea what he was trying to sell me. He was just trying to sell me the monthly payment, which I thought was insane. And then when we started talking about purchasing the vehicle, they didn't want to talk about interest rates. They wanted to talk about monthly payments. And I said, I don't care what the monthly payment is. I can buy the car in cash. What I want to understand is, what am I going to pay if I borrow the money from you versus taking the money out of a place in which the money is making me more money, like the stock market or crypto or whatever your flavor of investment is. And I thought it was interesting in the way in which they pitched it. But we've seen consumers over the last, let's call it 10 to 15 years. I call it the Netflix effect, right? Consumers are far more comfortable with these monthly subscriptions than they've ever been in their entire lives. We used to go to Blockbuster. I mean, I'm dating myself in terms of age there, but we used to go to Blockbuster. We'd rent a movie. We'd pay the $3, whatever it was. We'd take it home. We'd watch the movie. We'd go back. If we didn't have any money that week, we didn't get a movie, right? But now we look at the Netflix model, and because it's on that subscription base, and because we have to make that payment every month, we've become conditioned to continuing to make those monthly payments. And I think that there's some challenges that go along with that. Now, I think there's some benefits to it too. I think it provides opportunity to pay down larger sums of debt. And I think there's some areas in which it does make some sense. But I think all consumers, including myself, need to look closely at what we're willing to pay on a monthly basis because it's a subscription. And do we really need it? How many streaming services do we really need?
Right. Indeed. Yeah, I was consulting with someone, a customer of Solo, who came in. They were dealing with. They're in like a pretty good financial position. Really, they're dealing with a $15,000 debt or so,
Okay.
making like $100,000 a year. Yeah, quite a few subscriptions. Not an enormous number, but like Hulu, Netflix. I'd made a list of suggested costs to cut, and Hulu and Netflix were on the chopping block. And he said, "No, I can't cut those." And I was pretty sympathetic to his reason. He had a mom and a sister that were both disabled at his house, living at home with him. He said, "I can't cut those because they need something to do during the day." Very sympathetic to
Understood,
the
but
position
sometimes
in that situation, but also, I mean, it's discretionary spend.
it's a discretionary spend. That I think is a unique situation, and maybe 2% of consumers that are paying those subscription fees are on that, have a similar circumstance. And like I definitely can understand that, but you need both.
They need
And
both.
if we're trying to pay down a debt, sometimes we have to make some difficult decisions that we don't want to make in order to get there. I mean,
Right.
we've all faced financial hardship in our lives. I'm the only child to a single mom. I didn't start as the CEO of a company, right? This was all through a lot of hard work. And really the only reason I got to where I was is because I was willing to work harder than the people next to me. But that's really, what it came down to. Wasn't just the savings. And I think as we think about where are we going to save, it's also about where can we earn and how can we find or how can we turn some of the things that we love to do and enjoy doing into some sort of a cash flow, right? I've talked to people that are selling plants on the side. I started a YouTube channel with scuba diving videos because I love scuba diving and then tied that into the business. There's no tie between scuba diving and debt collection other than personal branding and just trying to find ways to leverage what you do actually enjoy doing to try and find those new cash flows, because a new cash flow is worth more, generally speaking, than a cut on another cash flow.
For sure. New cash flows. Love it. What actually happens when a debt gets sold or transferred? I want to preface that question
So
also. Right, you're the president of the RMAI. RMAI is a key industry association. Maybe you could tell us a little bit more about the RMAI here as well, in the process of telling us
sure.
what happens when a
Uh,
debt gets sold.
So RMAI is the Receivables Management Association International. It was originally the Debt Buyers Association. It's an international trade association focused on creditors' rights from a debt buyer's perspective, but they really do represent all different types of debt collection companies. The RMAI, I think, has been absolutely pivotal in cleaning the debt collection industry's image through the years. The RMAI, about 14, 15 years ago now, came out with a certification program. And I think that certification program has done more for the debt collection industry and for the consumer than any other program that I'm aware of. What they do is they've got a certification program internally where individuals have to meet certain education requirements. And then there is a giant list of publicly available items that they must comply with. And then it's not just me saying, like, yes, I comply. It requires a third party auditor to go through and validate that the individuals and the organizations are doing what they say that they're doing. Now, as a debt collection company, we see audits all the time because everybody that we work with is auditing everybody else. And I think that's been a driving factor when we're going to talk about compliance. But when it comes to what happens when a debt is sold, I mean, debts are sold both in the performing area and in the charge off area. So for anybody who has a mortgage, you probably got your mortgage through XYZ mortgage broker who got the original loan from ABC Bank. And then a couple weeks later, you get an email from Penny Mac who tells you they're now servicing the mortgage. And now you're going to be dealing with them going forward. So the sale of performing notes is something that happens on a everyday basis, especially for mortgages that get rolled up into securities and sold on Wall Street. Now, when we talk about the debt buying side of the world, what really happens is a debt buyer is an organization that invests in debt. Banks are not necessarily built to be debt collectors. Banks are there to service performing notes, to lend new money, and to make credit available. That's their underlying objective. And a debt buyer is an organization that generally specializes in how to manage distressed receivables. Some of them will collect the debt directly through their own call centers and through their own networks of attorneys, and others are going to leverage third-party vendors that are professional debt collection organizations. Think of a call center, but with a really specific purpose to be a debt collector and to communicate with consumers. And so really all that happens when a debt transfers from the originating creditor to a debt buyer is the debt buyer is just the second bank. They have all of the same rights and rules and regulations that that original creditor has when it comes to how are they ultimately going to collect on it. And the debt buyer themselves is an investment firm that buys that type of debt so that they can give cash to the bank, and then the bank can go lend that cash to make more credit available to more people. I know it sounds when we talk about debt buyers and some of the things that I've seen in the news or read about in the papers is, I hear some wild stories out there, and I think that there was a time, because the first time I read the Fair Debt Collection Practices Act, I said, we really had to write this down. Like these behaviors were happening to a point where we had to, not only did we have to write it down, but like Congress had to write it down and had to vote on this. And you read through it and it sounds like, some pretty bad behavior. And I would say probably even in the early 2000s, I think more consumers were potentially facing those types of things. After the mortgage foreclosure crisis or the recession or whatever we want to call it of 2008, a lot of that got pushed to the side. A lot of those organizations didn't survive. So now when you're talking about debt buyers, you're generally talking about pretty legitimate organizations that are either funded by investment banks, hedge funds, or other types of organizations. Some of them are self-funded, but debt buyers are just the second bank, and they've got the same objective that the originating creditor had, to resolve the outstanding debt. The debt buyer is not trying to create friction. They're generally looking to resolve the debt however they can. And I constantly hear the saying that debt buyers are buying things for pennies on the dollars. And I don't think that people truly understand how finance works if you truly believe that that's what's happening and that debt buyers are making billions of dollars sitting in the corner, because that's just not the reality of it. The challenge is that we're buying an asset that is not worth 100%, because not 100% of those people are ever going to repay that debt. And so debt buyers have to look at what are their expectations, and they kind of have to bet on what their expectation is of that portfolio of consumers, that group of 100,000 consumers actually repaying these accounts. And there's a variety of factors that go into that, but I promise you, it is not pennies on the dollar.
Yeah. Well, can you tell us, break that down a little bit more for us? Like, let's say like a debt collector buys a $100 debt.
So if a debt buyer, so if they're easy numbers, if they're buying a $100 debt and maybe they're paying 20, 25 cents for that debt, if they can collect 30, 35 cents out of the total portfolio on average, that would be a pretty aggressive rate of return, no?
Right. Yeah. Yep. And
So I think that's probably a little bit more realistic in terms of how that works, because you have to look at things on the aggregate, not just the individual consumer accounts. You have to think about things from a broader perspective, because
sure.
those, now of that let's call it 20, 25 cents that was spent for that purchase, that money's going back to the originating creditor, that's going back into their lending pool and actually making it back out to the consumers that need that money.
Right. Yeah. So if the collector buys a $1 debt, the debt's not worth $1, it's worth 33 cents maybe. And so the debt collector can buy it for like
At
25 cents.
best, right? Like at best.
Right.
Because it's the discount of a cash flow. So it's the same way that you look at buying a business, right? If you're going to buy a business and that business is making $100 a year, you can't pay $100 necessarily. You're trying to buy that at a discount at 90 cents, at 80 cents, right? Because it's performing. And when you're buying performing loans, for example, if it's let's say $100 loan that we're trying to buy and it's performing, the seller is going to want $120 for it because of that anticipated interest into the future. And so that debt buyer who's buying the performing note may have to pay 110. Right? That's just the reality of it, because when you're looking at buying a cash flow, it's either you're buying it at a premium because it's performing, or you're buying it at a discount because it's non-performing or delinquent, defaulted, or charged off. And those different things are going to have different values, because there's more value in a portfolio if the consumers are actively making payments. Even if it's charged off, but the consumers are now actively engaged in making payments, that's a little bit of a different, challenge. But to say that we're going in and buying it for, 2 pennies and collecting $100 is just not the reality of it. It sounds like a great business, but that's not really how things work.
Right. This sounds sensational. Right.
It sounds like a great headline, doesn't it?
It sounds like a great headline, right? Indeed. Folks, for those listening live, we got lots of people listening live. If you have a question you want to put to me and to Adam, call into the Debt Hotline at 801-613-8181. We'll talk with our wonderful assistant of the show, Hannah, and she'll kind of plug you in and let you know how this works. So call in, numbers right here at the bottom, 801-613-8181. We also have some questions from listeners that we are going to be getting to. Before we get into that, one last question for you here, Adam. How can better communication between collectors and consumers lead to more successful outcomes?
Oh my gosh, transparency in the communication process is the key to everything. Look, I think the biggest challenge that consumers face when they're facing a collection agency or they're facing a debt is hiding and saying, I'm not going to communicate, not taking that phone call, not responding, not going to the portal, or taking any action at all, because a debt that's not engaged with is just a compounding problem for the consumer. So I think the more that we can have a transparent communication process, and the more that you're actively communicating with the organizations, I think the better off you are. That's been my experience through the years. Now, I think there's some exceptions to that, and I have a feeling we're going to cover a few of those as we look at some of the questions that have been posed by listeners or followers. So, we'll cover some of that, but transparency in the communication process is always going to lead to a better outcome, because the debt collector or the debt buyer does not want to litigate. They do not want to go to court. They do not want to file for a judgment. It's expensive, it's time consuming, and it's not what they want to do. So if you're communicating with that debt collector and you're willing to make payments, or you're offering reasonable settlements, I think communication at all is a better place to be than hiding. Because when you hide, depending on the size of the debt, if it goes into litigation, your options become narrower and narrower when you have not engaged in the conversation.
That is the truth. All right, jumping into some questions from listeners. We have Veronica in California. I am being sued by Wells Fargo. I owe $26,376.90. 26,000 is quite a bit. I do not have any more debt in collections. I'm working with Century Support Services, a debt settlement firm, where the account is enrolled. They're trying to negotiate the debt, but Wells Fargo is not cooperating very well. I'm also working with Solo. I sent in my response, and I have sent in the response to request for admissions to their law firm. I've sent in the reasons for falling behind on payments. My question is, what happens if Wells Fargo refuses to negotiate any settlement and insists for me to pay the whole amount back? But I need to get a lawyer. I really cannot afford one.
So the first question that I would ask in this situation is like, have you talked to the bank directly and have within that process? Now, it sounds like there's already been a lawsuit, right? I sent in an answer. Sounds like a lawsuit has already been filed.
Mm-hmm.
So if a lawsuit has already been filed, I mean, like, the bank is under no obligation to negotiate down. Generally speaking, the bank would be willing, the debt buyer is going to be willing to accept payment plans to pay down, even if they're not going to be willing to accept it. But there's somebody looking at that account who's making this decision. Now, it's such a large balance. I mean, litigation has clearly already been commenced. And if they're not going to communicate or they're not going to be willing to negotiate, don't miss your court date would be my next best piece of advice. Like, don't allow it to become a default judgment. You're going to need to go to court. Now, do you need to have a lawyer to go to court? What's the saying? A person who represents themselves has a fool for a lawyer. So it's probably better to have an attorney than to not have an attorney. If you're going to have to go to court, hopefully they see the solo settlement option and they're, are going to react or respond to that. But it's hard for me to provide really specific advice without knowing how much were those offers and what law firms are we dealing with and that kind of information. But from a Wells Fargo standpoint, if Wells Fargo is not responding to anything, then they are going to be in court and they're going to respond there.
Yeah, that is all on point, Veronica. Some things I'll add, right? So solo. We have a lot of customers in California. If you haven't made an offer to settle the case via solo settle yet, you should go ahead and do that. Use our settlement option. You can use that in addition to Century if you'd like. We're really focused on having good relationships with collectors as well as consumers. So oftentimes, depending on like the law firm, we'll have a bit of more of a clear path of access and communication with the person that is doing collections on this account. So yeah, 26,000 is a lot of money. That means that like the stakes are higher, right? So it sounds like Wells Fargo hasn't sold this debt probably, right? It's 26,000 debt, probably haven't sold it, trying to collect on it themselves. You don't have other debts. I'm guessing that probably suggests that your financial position is like pretty okay, right? Maybe you're like making some income at this point. You've probably resolved other debts, probably doing better financially than you were in the past. So Wells Fargo's probably thinking you have pretty good ability to pay on this debt. I suppose the question is, what's this debt settlement firm doing for you? What kind of deal are they trying to offer? If you go through solo settle, you can have a bit more direct access and like control over what you want to offer. Maybe you can get onto a payment plan over 36 months to pay off the full amount, maybe 80% of the total amount, something like that, and try to get some kind of a deal here.
That sounds a little bit more realistic, George.
Yeah.
that sounds like a pretty good option.
Yep, sounds like a pretty good option here. We have a live caller who should be joining here shortly. We got another question here from Michelle in Florida. If you're being sued for a debt, is it better to settle with the lawyers before it goes to court or go to court on your own if you don't have money for a lawyer?
So I'm going to repeat what I said. A person who represents themselves in court as a fool for an attorney, I would reach out to the law firm in advance. Even if it can be in advance of the suit being filed, because now court costs haven't been invested and the law firm and the creditor are less invested in that and probably more likely to have a conversation, especially in Florida, which is where I live. I could tell you the lawyers that I talk with there generally are reaching out via digital channels in advance of actually filing a lawsuit. So they're trying to call you, they're trying to text, they're trying to email. Like that's a good time to engage sooner rather than later. The further it goes down the process, the less options the law firm is even going to have because the creditor is not going to enable them to negotiate in the same ways.
Right. Yeah, I totally agree there, Michelle. You can certainly try going to court, right? We have people who do that. Generally speaking, settlement is going to be the best option. The lawyer probably works with the judge on like a weekly or daily basis. Right? Oftentimes, debt collection lawyers are some of the more popular, commonly appearing people in a court. So they're going to like know the judge and et cetera, et cetera. You can settle before going to court. That will be best for you. We got a live caller, Joyce. Joyce, I'm going to plug you in here. Joyce, how's it going? This is George.
Good afternoon.
Hey,
Hello,
tell us about
how
your
are you?
situation. You're good.
Well, about 18 months ago, I turned over about 10 credit cards to a debt consolidation. And they call me every month wanting more money from me. And the reason I gave them the credit cards was because I couldn't make all those payments. So if I had more money to give them, I would have done it myself. Well, now I'm being sued by one of those credit card companies because the debt consolidation people hasn't made any contact with them. And I'm very upset over this because they're charging me money to do this and they're not really doing anything.
Right. Yeah, Adam?
So that's I had a family member in a similar situation, and what I found was that the debt consolidation firm was paying late on they making the payments, but they were making the payments late every month, and so that the late fees from the credit cards were offsetting, and they were never going to actually dig out of debt. So I have to. It's clearly not working for you. So of the 10 credit cards that they are currently managing, how many of those cards have they actually made any progress on?
They got one of them paid off, and they say they're paying on 6 others.
Okay. Do you have any statements or anything to support that? Like, are they providing you with any documentation to support it?
No. They have a website I can go on, but it really doesn't give me a lot of information. I just know that all of the credit cards over 18 months is doubled in what I did owe them in late fees. And
Yeah, because the interest is still running and you're not seeing any kind of progress there. Joyce, it sounds like that organization is not working for you. And absent of an opportunity if you've got this many cards out in an active lawsuit, chances of a debt consolidation loan are pretty slim. So I look at this and I say it might be best for you to kind of lay these out on the table and say, here are the 10 things that I need to start working with. Reach out to each one of those credit cards and validate where you actually stand with each one of them, because they may be willing to work. Like it sounds like all of this is charged off. And if all of this is charged off, they may at least be willing to set up payment plans. And if you can get 10 payment plans going at $25 a month or whatever the case may be, that may be a better situation for you overall than continuing to pay into the black hole that does not seem to be helping you see the light.
it's getting worse, and my credit score has just bottomed out. It's horrible.
Joyce, when did you say you enrolled in the debt consolidation program?
18 months ago.
18 months? Okay.
Yeah.
Usually a program takes, the average is 24 months. It takes 24 months to get cases like settled or debts settled.
Well, they told me
usually
it
they'll
was
start
going to be
around 12
3.5.
months.
Yeah, they told me it was going to be 3.5 years
to get
before they
everything
got
fully resolved.
everything. Well, and I didn't know
which
what to
I
do
can
with it.
totally understand. When you're talking about
Yeah.
that time frame, like that's understandable, but it's about understanding where do you currently stand with each one of these, because it sounds like the debt is not going down, the debt is going up. And if the total
It
volume
has-
of the debt is continuing to rise, like there's some challenges there that need to be addressed.
Yes, and this lawsuit that I got, I did not know what to do with it, so I called them, and they said they had a legal department, and they didn't really help me. They didn't really answer any of my questions, so that's why I got on with Solo Suit, and I hired them to go to the court for me.
Nice.
Mhm.
Yep. That's one of the things we do. Yep. We help you just respond to the debt. And oftentimes I think about that, putting you on the right path and as a step towards settling the debt with the collector. How much total debt do you have in this program, like altogether?
Well, now it's about 25,000.
Uh,
It wasn't that much.
how much was it when you entered? Would you ballpark?
Probably about a little about 14,000.
Oh well, it's a big increase. And
Yeah,
what's
very
like
big.
what's your income like?
I have a part-time job. I work maybe 3 or 4 days out of the month.
Uh-huh.
Other than that, my husband and I live on Social Security,
Okay.
and we don't have any savings or anything like that. So,
Right. Right. I guess that's like somewhere between like $30,000 to $60,000 a year, something like that. I bet.
I wish.
Okay.
No,
And then
no.
and then so that's where the debt's at. How much money do you have in the escrow account with the debt consolidation firm? Do you know?
I'm sorry, it was cutting out on you.
You have money in an escrow account with the debt consolidation firm. How much money is in there? Do you know?
I couldn't
Do you
understand
know
the
how much?
question. It was
Do you know how much
our
money is in
connection
your
is
escrow
not
account?
good.
Looks like our connection is getting a little choppy. Do you know how much money is in your escrow account with the debt consolidation firm?
I'm sorry, I can't understand you.
It's like
Can
we're
you
losing
hear
you,
me?
Joyce.
We're losing connection.
Yeah, we can hear you.
Okay. I don't know if I contact these people, are they going to want me to settle with them because I don't have it?
Joyce, our connection there was breaking up, Joyce. If it gets stable again, have you back on. But I think my take would be to find out how much money is in your escrow account, right? So the debt settlement firm, usually you're paying in monthly into an escrow account with them. And there should be some kind of a balance there. So consider that an asset. And certainly you can try going after this on your own. We've got David calling in. David, let's go ahead and plug you in here.
Hi, how you doing? Can you hear me?
Yep. How's it going?
I have a question about if I have a car that stopped running and I know I can't continue to pay for the and the car fixed, the engine is blown out, $75,000, so I don't have to receive the car company will not.
It's not our day for internet connections.
You're hearing me okay, right, Adam?
I hear you just fine.
David, you're having trouble as well, Adam, on the connection. Sorry about that, David. Maybe if the connection gets better, we can plug you back in. Let's give David one more shot here.
You hear me now?
Yeah, we can hear you now. Yep. We'll just have you on audio. Yeah. Yeah, that's not working out. Sorry, David, go ahead and put your question into the chat and we will see if we can get your answer there. Same with you, Veronica. You can put your question into the chat here. In the meantime, I'm going to go on to another written in question from a listener. This is from Kayla. I owe about $3,800 to Capital One. They've been calling and sending letters, but I haven't been sued yet. I don't have any other debts and collections. I just fell behind because I graduated in December and couldn't find work in my field. So I've only been able to get a part-time job at a grocery store this year. My question is, how often do judges actually dismiss these cases?
The actual number in terms of how often are they dismissed? There would need to be a reason for it to be dismissed. But you haven't been sued yet, right? So like the judge, there would have to be something wrong on the creditor's side for the judge to dismiss it. So I would say 0 chance unless there's an actual problem. My suggestion would be you haven't been sued yet. Have you called Capital One and talked to them about your current hardship, where you stand? Right, you may not have access to spending on that card going forward if it's delinquent, but I think having a conversation directly with that originating creditor would be my first step so that the account doesn't get sold or does not get put into a litigation channel. It's better to just try and address that up front. If you're having a real problem, like Capital One is a major organization and they want you back as a consumer again in the future, I think they'd be willing to listen if you're willing to reach out. I think when the account gets sold or the account gets sued is when communication breaks down. And just like George had pointed out at the beginning, the transparency in the communication process, I think, is paramount to the success of both the consumer and the creditor.
Yeah, that's right, Kayla. Yep, try not to disappear on Capital One. Highlighting Adam's point there, Capital One wants you to be a customer into the future, believe it or not, right? So they would like to keep you as a customer in the future. Bummer you haven't been able to get a job in your field. Keep on looking, see what you can do there. If you got a deal on the $3,800 debt across 24 months, that'd come out to $160 a month or so. And oftentimes at this point in collection, something that's very nice that collectors do oftentimes is to actually stay the interest, right? So at this point in time, if you settle with Capital One, you won't be paying any additional interest, right? That wasn't the case with Joyce, who called in, right? Joyce, I think, she wasn't able to get that deal arranged. Oftentimes, if you'll settle through Solo at this point in time, make a deal with Capital One, you can get that interest fully stayed so that the balance won't be a moving target, won't be moving up on you while you're making payments. We got another question here from Tasha in Massachusetts. I'm being sued for a credit card debt from JP Morgan Chase for $17,000. I answered the summons within the time frame, then submitted a settlement offer to the law firm representing the credit card company on November 6th. How long generally until I receive a response, or will they not respond at all? I do have other debts that I'm paying off through AmeriCorps, another debt settlement firm. Chase or their lawyers did not respond to AmeriCorps' emails. I was laid off from my job in October of 2022 and was out of work looking for employment for about 6 months. It's put me into a financial hardship.
So that's always a hard one, right? Because you're talking about a large enough volume to where litigation makes sense on behalf of the creditor, even in a state like Massachusetts where the court fees are pretty high and the courts are difficult at best. You submitted a settlement, November 6th, and how long is it going to take for them to respond? I would say normally they're going to look to respond fairly quickly if they're willing to listen to that settlement. Again, this is a hard one. I mean, it sounds like you are, dealing with a hardship. And if Chase still owns that account and the lawyers are not responding, now the lawyers are, when you say that you submitted a settlement on November 6th, is that AmeriCorps submitting the settlement or is that the consumer submitting the settlement? Because I look at those a little bit differently because some creditors, just like some collection operations and some debt buyers don't work with debt settlement firms. They just don't, because it's for a variety of different reasons. So I may want to reach out to that law firm directly if you haven't already, or look at using Solo Settle to try and reach out to the firm through a platform that's providing some additional transparency.
Yeah. So again, yep, 17,000 is pretty significant, right? Chase is going to have pretty high interest in recovering that amount. Tasha, so sorry to hear that you lost your job. I definitely would suggest on ways to find a new cash flow. Kind of like Adam was saying, right? You made scuba diving videos at some point in time, right? Right? I don't know if that's available to you, Tasha, but there's probably something you can do to generate some cash flow, right? You don't have to wait around and get a job from somebody. You can make your own job, start selling something, use whatever skills you have available to you to get some income and start getting yourself back on the right track. The fact that you have a $17,000 debt with Chase, indicates that you made quite a bit of money at some point in time in your life for them to be able to give you that balance and credit limit. And hopefully you can get back on that right track again soon. We have somebody who left a message on our voicemail that I'm going to pull up and play now.
Yes, I have a question. I had several credit cards, some business and some personal. My business is closed and I was not able to pay them in full, so I settled with a few of them. There was a total 3, so I settled with the 2. One did not. And I do have personal credit cards, which I'm paying okay. Currently, my income is flexible. I wanted to see if I looked at my credit score, which is kind of really totally messed up now. Is less than 500, like 470, 480, due to the being behind on those payment on the business card. Is it okay for me to really go ahead and settle other card, which I'm paying with some reserve money, the personal one? Because my credit anyway has been really messed up now. So will it be okay to settle or either not to pay in full those cards, since other cards are, causing my credit scores to go so bad? So question is, what should I do? I mean, should I keep paying on other card, the personal one, but my credit score is really messed up due to the settlement? Let me know, what should I do? Thank you.
So let me restate this, George, to make sure that I'm understanding, and let's see if we have the same understanding here. So you had business cards and personal cards. He settled on the business cards, which had a personal guarantee if it's impacting his personal credit, right? So he didn't pay those, and now his credit score is low. He's got some other active cards that are still performing right now, and wants to know whether or not he should stop paying on the performing cards.
Yeah, I think he's wondering, especially if he should settle his personal credit cards.
So if they're currently performing, you don't want to take them out of performing status, because I think you have to consider how a credit score is calculated, right? And having the negative mark on the credit score, but the only way to offset that negative mark, other than it timing out, which is a 7-year process, would be to have some performing credit and to demonstrate active performing credit. I think it would also be better, like if both the business and the personal cards are non-performing, I think getting any kind of credit in the immediate future is going to be next to impossible. So I hesitate to tell people to stop paying a performing card. Now, if that's currently a non-performing card, meaning it's
what do you mean
charged
by
off
performing?
already, it might be different.
You just,
Performing meaning that it's still it's an active card, right? It has not gone to it hasn't gone delinquent, it hasn't gone into charge off. I would never suggest that you start doing that, because like when we were talking to Joyce, her credit score is a 350, right? A 470 something, like he can start that can start to build back over time. But if you just let it go all the way, I know it feels like you're hanging from your fingernails sometimes when you're talking about this stuff, and like you're just kind of hanging from the ledge, but sometimes that's a better place to be than just hitting the bottom of the pit.
right.
So I look at it in terms of if you still have performing cards, I would keep the performing cards going if you can. Now, if it's just burning your final reserves and that's the money that you're going to need to live, that might be a different situation, right? And you might have to let that go because you had a business, the business didn't work out, and But part of my answer to this, in a one-on-one situation, would be about how much time you have to recover until retirement. Right. Like our risk, the amount of risk that we're willing to take on as individuals changes throughout our life cycle. We're willing to take great risks in our 20s, and our risk tolerance lessens in our 30s, and even more so in our 40s. And the closer we get to retirement, the less risk tolerance we have and the more risk averse we become as we reach our 60s and into our 70s. That's not me. That's just kind of general finance. But my answer to that question, because it sounds like there's more to this equation than is just in that voicemail. So I hesitate to say it, but I hate to let go of a performing card, because a performing card is an asset to your credit calculation. And you can go to any of the credit bureau's websites. They'll tell you exactly how their credit scores are calculated, right? There's credit utilization. There's a piece related to your on-time payments. There's a couple of different components to it. So I think you have to consider that. Just because your credit score is low now, right? In the 400s, low 500s, you could still potentially get another vehicle loan if and when you needed a vehicle. But once you go to that 350 range, you're in buy now, pay later territory. And the worse the terms of the loans that you're going to have to take in the future, the more difficult your life is going to be, and the more difficult it'll be to get out of the cycle of debt.
All right. We have one more live caller calling in. That's it for today. We just have time for this one more call. Ruby, how's it going?
Doing okay, thank you.
Good. Is your name Ruby? Is that right?
Yeah. Yes, that's correct. Yes. So my question is, I received a letter from a debt collector stating that I owed from a company a big amount of money, but I never opened an account. This account is not mine. Somebody used my information to open this account, and it was sent to so now it's sent to this debt collector. And the debt collector is asking me, since I'm disputing this account, they're asking me for very sensitive information, such as the copy of my social security, my driver's license, the utility bill. They're asking for an affidavit, a copy of police report if filed. But I'm I don't want to send that type of information, whether it's through email or mail. And I am very worried about this, and I don't know how to go about it.
I think that's a great question. Have you tried reaching out to that originating creditor,
Yeah.
like whoever's saying that the debt is owed
Yeah.
to validate that debt collector is working on their behalf?
So what they told me, they didn't have much information. They couldn't really tell me much, but simply verify. For example, they asked me for the last four of my social and my mailing address. They didn't have any information since the account was given to or sent to this debt collector. The debt collector sent me, it seems like a statement of what the account was and how it's been going since it was opened. But other than that, I don't have any other type of information, and they're asking me for all of this to be sent out
But
to them.
when you called the bank, right, or you called the originating
Yeah,
creditor,
correct.
they told you that the debt collection, you validated that at the least the debt collection agency is working on behalf of the creditor.
The debt collector is the one that is now in charge of the account, so they didn't have any
Okay.
information on file.
Okay. I would talk, I mean, the debt collector, I would hope would be able to take that information in through a self-service platform. Now, all of the information that you just mentioned is generally part of that fraud affidavit. So there's an affidavit that fraud was committed because they're trying to prove the case for you ultimately
Okay.
in this instance, because the debt collector wants to be able to go back to the creditor and say, this was legitimate fraud, like this one's on you. But in order for them to do that, they're going to have to go in with some information that validates that. And I think they're trying to collect this information so that they can prove that prove your story,
Okay.
right? That this wasn't me. I didn't do it. Like the debt collector ultimately wants to validate
Correct.
that. Like a debt collector's job is to
Mhm.
come to resolution.
Mm-hmm.
It used to be to collect a debt. Now it's to come to a resolution. Like whether it's a positive or a negative resolution, the job is to come to a resolution.
Okay.
Because you know what the bank doesn't want to do? The bank doesn't want to chase people who don't actually owe the money, because that's not going to help. You're never going to pay a debt that you don't owe.
Mm-hmm.
So they're trying to get that information together. I also think that it's very uncomfortable to have to send that information. I would not want to send that in the mail either. I don't trust the U.S. Postal Service with that kind of information. You shouldn't either. Now, if I have to send it somewhere via mail, let's go in FedEx. I'm sorry for the expense, but that's just me, right? FedEx, UPS, something that's return receipt. I want to make sure that the address that I'm sending it to matches what's on their website.
Okay.
Right? I want to make sure that I'm sending it to the right person. But if they have an online portal and that matches the domain in which you've been communicating with them with, then I'd be more comfortable loading it to their online portal, because they're generally going to have what's called a SOC 2 Type 2 compliance, or at least a PCI DSS compliance if if that portal also takes payments, which makes me feel a little bit more comfortable. But if I have to mail it because that collection agency is maybe smaller and doesn't have that kind of technology available to them, then I would want to send that via something return receipt. And I mean, maybe it's just my aversion to using USPS, but I would want to use a more professional organization.
And they
I
do
always tell
have a
people,
portal. They do have a portal. So they gave me
Okay.
that option. Automatically, as soon as I saw this letter from the debt collector, I went and checked my the 3 credit bureaus. It seems like the account, the amount, or there was an inquiry done when the account was opened. But there is nothing, there's no trace or anything that there's even an account open.
well, I mean, in terms of the credit bureaus, the inquiry being there, the question is whether, depending on who the originating creditor is, do they report to credit bureaus? Do they report active accounts to a credit bureau?
Oh, okay.
So that could if I'm not mistaken, the rule is that there has to be at least 500 accounts opened in order to do that. Now, if this is a fraud situation, the first thing I would tell you is to go to all 3 credit bureaus and freeze your credit. It's free, doesn't cost you a dime. It happened to me recently, and I got a call from the credit card company that I use, and they say, "Why did you try to open this account? You have these other accounts with us." And I didn't try to open that account.
I see.
Right? And I'm hypersensitive to the security of my information.
Mhm.
I don't even think anybody outside of my wife knows my actual birthday.
Okay.
Like, I'm overly sensitive to these things. So it can happen to anybody. And so I would go and lock down that to make sure that the leak doesn't get any bigger.
Okay.
And I would communicate with the debt collection company, because it sounds like they're legitimately trying to make this thing go away. And if the account is already opened and the inquiry already shows on your credit bureau, somebody already has your information. It sounds like legitimate fraud to me.
Mm-hmm. Okay.
All
Well,
right, Ruby,
thank you
thanks for
very much.
calling in.
Thank you. Thank you very much.
All right, folks, that's all we have time for today. Again, this is the Debt Hotline. I'm George with Solo. We've had Adam Parks on the show today. Thank you, Adam, for coming on.
I appreciate you having me. I hope some of what I said was helpful. I know it's not always what consumers want to hear, but I hope it was helpful.
Well, it's been fantastic having you on the show. Nobody knows more about this than you do. Folks, if you have a question, you can always call in to 801-613-8181. That is the Debt Hotline. So if you have a question during this week or next month, whenever, call in 801-613-8181.